This chart represents the growth in the UK economy, or GDP, which is a key measure of how the economy is performing, if it's growing or declining. The Office for National Statistics predicted we'd have a minus 0.3% of growth in November, but the economy has actually outperformed this and delivered 0.1% growth. Now, 0.1% does seem low, but in the scheme of things it may mean we aren't in a recession as most people, including the Bank of England, has predicted. Well, not yet anyway. It might surprise you that one of the main contributors to this growth was actually the service industry, with punters packing the pubs to watch the Qatar World Cup, suggesting things are getting back to normal after the disruption of the late Queen's death, with an additional bank holiday seeing most businesses close. Other industries have also done pretty well, in particular telecoms and IT, with the admin industry holding up well. And here we can see the impact of the World Cup boosting the UK's growth. But the growth has been offset by further falls in manufacturing and in pharmaceuticals, as well as falls in transport and postal due to the impact of the strikes. The strikes may have had quite a significant impact on December's figures, which are yet to come. This growth would have been even stronger if it was not for the continued unwinding of the test and trace vaccine, which dragged growth down by a further 0.2%. The good news though is now the economy needs to shrink by 0.6% in December in order for us to be in a technical recession. 2 quarters of negative growth. This news has given a nice boost to the FTSE, which I've definitely felt. With my ISA portfolio 80% invested in UK companies, I'm up around 4% in the last month. Despite this nice boost to the start of the year, we aren't out of the woodwork just yet. Now, we may not be in a recession just yet, but the UK's monthly GDP is still 0.3% below its pre-pandemic levels, and we're now the only G7 country with a smaller economy than before COVID-19. Comparing it side by side to the other G7 countries' 2022 growth to date, it's quite a sad picture to see. And while the growth in November means it's much less likely we were in a recession at the end of 22, the following chart is a reminder that the Bank of England and the OBR, the Office for Budget Responsibility, are still expecting the economy to contract or perform worse from where we are today in 2023. The slight good news though from this chart is that both are predicting it to continue to climb upwards from around 2024-2025. And what's interesting is even when we hit 2 quarters of negative growth, which is classed as a technical recession, as demonstrated by this amusing article from the San Diego Tribune, 76% of people believe the US is already in a recession. And after asking 16 of their correspondents, which includes economists and business leaders, they can't even agree if the US is in a recession or not. In fact, most of them say they aren't. Quarter 3 for the US was actually far better than 1 and 2, up to 3.2% growth driven by strong export and consumer spending. So if we do enter a recession, it doesn't technically mean that that's the end for growth. But the real question is a recession to come in the UK for 2023? In its outlook for 2023, Goldman Sachs have forecasted minus 1.2% growth in the UK over 2023, which is well below all other G10 economies, followed by some growth in 2024. This figure would put Britain only fractionally ahead of Russia, which is predicting minus 1.3% growth, at a time when they're waging war with Ukraine and have punitive economic sanctions, which is shocking. So why is the UK doing so badly? The UK's Independent Office for Budget Responsibility is projecting that the UK is facing its sharpest fall in living standards on record. Alongside Jeremy Hunt's budget in November, the OBR are forecasting real household disposable income, which is a measure of living standards, will fall by 4.3% in 2022-2023. This squeeze on income is the main driver, as high inflation and interest rates are crippling household spending. The Bank of England raised rates to 3.5% in December as it hoped to rein in inflation, which has eased slightly from its recent 41-year high, but this rate is expected to increase to 4% during the first quarter of 2023, which will then turn into a wait-and-see approach to see if the inflation eases. The labour market is set to start declining from the first half of 2023, with unemployment reaching 5.6% by mid-2024, an increase of around 680,000 people, as businesses either shut down or they're cutting workforce to stay afloat. On top of that, the spiking food, energy and inflation has already cut into household spending. With these rising rates, lower household incomes are going to be particularly exposed. Unfortunately, the most affected categories are essentials, with not many substitutes in the short term. Now, a lot of countries are facing the same sorts of issues, but they didn't have a poorly timed Brexit, they're not spending so much to cap energy prices, and arguably some of them didn't spend 30 billion on a track and trace app. The truth is, none of us want a recession, but they are an important part of the stock market cycle and completely normal. And whether it happens this year, next year, or in 5 years' time, one will be coming. The word recession is quite terrifying, but actually as an investor with a long enough timeline, we actually want them. Just imagine if you'd bought in every recession, how much better your returns would be. So if you continue to average in through all of these economic downturns, you should see some amazing returns in the future. The one thing to highlight here though is from an investing standpoint, a recession is scary, but it's overlookable. But the real downer here is there are real people struggling with a cost of living crisis who are just about able to pay the bills. If you know anyone struggling in this situation, try to do what you can to help them. I'm trying to spread as much as I can here about investing, saving money and ways to make a bit of extra cash, which I'll continue to do. But you'd actually be surprised how many of your friends might not have a savings account getting even 3 or 4% interest. This week I've actually helped 3 people I know set up cash ISAs and they're now getting 4% on their savings. So make sure you give your friends a nudge and make sure they're doing what they can. So let's keep calm, see what happens throughout 2023 and keep on investing. If you're looking for some extra ways to top up your earnings or just some extra cash to invest, check out this video with some side hustles that I think are great if you don't have a lot of time. Thanks for watching and I'll see you guys in the next video.